Welcome to the Deep Dive. Today we're tackling a really critical mission. We're going to synthesize the institutional view of the market as it stands on December 15th, 2025.
Right, and we're pulling this directly from the vivimoneyDaily report.
Exactly. We want to give you the shortcut to understanding a financial landscape that's, well, it's defined by what we're calling an extreme bifurcation.
That bifurcation is absolutely the key word. What we're seeing is a market that's it's cautious on one hand, but also highly concentrated on the other.
Driven by two completely different forces.
Two colossal different forces. And our goal today is to really connect those two threads for you so you can see why certain assets are diverging so sharply right now.
Okay, so the big picture summary is this. The whole market structure is shifting. First, because of a new, pretty technical liquidity tool from the Federal Reserve, we'll just call it RMP.
And at the same time, risk appetite is being driven by this massive event-driven news out of the semiconductor and AI space.
Specifically involving NVIDIA's H200 chip.
Right. So for you, the learner, the context here is vital. You have to get the technical side of the central bank's action first, and then you overlay the immediate, headline-driven risk.
This clash between deliberate policy and reactive sector news, that's what's setting the tone.
It's setting the entire tone for asset allocation today.
All right, let's unpack this. We have to start with the structural catalyst, the Fed's big new move.
The biggest technical development is definitely the launch of these reserve management purchases, or RMP.
And this isn't just routine stuff, is it? This is a totally new instrument that the New York Fed just started executing on December 12th.
It's a signal event, a really big deal in reserve management. The Fed even published a whole implementation note detailing the tool.
So what does it actually do?
The initial phase involves buying short-term securities. It's designed to total roughly $40 billion in the first month.
40 billion.
Functionally, RMP is built to actively redistribute short-term reserves inside the banking system. It acts directly on the very front end of the funding curve.
But why now? Why this new tool? And why is $40 billion getting so much attention? I mean, it seems kind of small compared to past QE cycles.
That's a great question, and it really gets to the heart of the whole institutional debate right now.
Yeah.
The reason it matters so much is it's twofold.
Okay.
First, the Fed is basically fighting these structural pressures that create reserve scarcity in certain corners of the market.
Yeah.
And second, by introducing a new ongoing purchase tool, it immediately raises a critical question.
Which is?
Is this just a temporary technical fix to manage the overnight interest rate? Or is it, as some analysts are starting to call it, a disguised form of balance sheet expansion?
A disguised form of expansion. So basically a kind of covert quantitative easing.
Precisely.
Something to inject liquidity without, the big QE announcement.
Exactly. If this RMP thing becomes a persistent structural feature that's needed to keep control over rates, then the market's expectation for future inflation, it shifts fundamentally.
The market is always sensitive to anything that even smells like permanent balance sheet growth.
Intensely sensitive. It doesn't matter what the Fed's official technical explanation is.
So while the Fed is managing the financial plumbing, the market's risk appetite is being pulled by this completely different, very visible force. Let's pivot to catalyst number 2, the NVIDIA H200 situation.
This is where all the event risk is living right now. We have multiple reports confirming just exceptionally strong demand for the H200 chip.
And a huge chunk of that demand is coming from China, right?
A huge portion. And that demand pressure is forcing NVIDIA to openly talk about substantially ramping up its production.
What's so fascinating here is that this isn't just a revenue story. It's about massive regulatory and supply chain exposure.
Oh, absolutely. The magnitude goes way beyond a single stock price. This intense demand, especially with the geopolitical sensitivity around China, has triggered direct inquiries from the U.S. Congress. It puts a spotlight on everything: export controls, production capacity, the vulnerability of the whole global supply chain. For the semi-sector and the AI ecosystem, this is the single biggest, most immediate catalyst, and maybe the biggest risk point driving volatility.
So you have new liquidity from RMP propping up the short end, and then extreme event risk from NVIDIA.
Yeah.
Let's see how they're colliding in the markets, starting with fixed income.
The RMP's fingerprints are all over this. If you look at the benchmark rates, the 10-year U.S. Treasury is hovering near 4.18 to 4.19%.
Okay.
But the 2-year U.S. Treasury is way lower. It's holding steady near 3.52 to 3.53%.
That 2-year rate, staying so close to 3.5%, it feels almost anchored, like it's directly tied to the Fed's new operation.
That's exactly right. The market is reading RMP as a direct mechanism to keep the short end well-behaved.
So it's being heavily influenced, if not controlled.
Yes. RMP is ensuring there's enough liquidity distribution, which stops short-term rates from spiking because of any technical scarcity. Meanwhile, the curve itself is just notably flat.
And that flatness shows uncertainty.
A lot of it.
Yeah.
The market is still worried about a renewed inversion or spread changes because, while inflation is falling, it's still above that 2% target. And employment is still very robust. The policy trade-off is painful.
Okay, let's jump to equities, because this is where that bifurcation is just so obvious. The market has literally split in two.
It really has.
If you look at a broad index like the VOO, that's the S&P 500 ETF, it's been relatively steady. Recent closes around, $626 to $632? Defensive stocks are fine.
But that's only half the story. You have to contrast that stability with the high volatility event-sensitive tech sector. Look at the QQQN, the NASDAQ Q100 ETF. Its recent values are bouncing all over the place, between $252 and $259. The huge difference shows capital is flowing into two totally distinct pools.
So RMP is creating a floor for the broad market, but the NVIDIA story is just injecting pure volatility into tech.
You've got it. RMP provides macro liquidity, NVIDIA provides reallocation risk.
Can you give us some concrete examples? How are those big tech names reacting to the H200 risk?
They're almost purely event-driven now. NVIDIA itself is fluctuating wildly between $175 and $185, reacting directly to the H200 news and the regulatory risk.
And it spills over.
It spills over. Meta, closing near 640, 650, it's moving on its own AI rollout strategy, which of course depends on chips like the H200. And Alphabet, GOGL, trading around 309 to 314, is reacting to ad strength, but also its own internal AI builds and regulatory news.
So it seems like if you're not a major tech driver, you're enjoying the Fed's liquidity. But if you're exposed to AI, you're on a geopolitical roller coaster.
That sums it up perfectly.
Right.
And that brings us to the frontier of speculation, the crypto market.
Right, yeah.
Bitcoin is currently bouncing between $88,000 and $90,000.
Yeah.
But despite those high prices, the overall psychological sentiment in the ecosystem, it just feels weak.
The psychology data really shows this divergence. The VIX for the S&P 500 is pretty low, around 15.7.
Suggesting low fear in traditional stocks.
But the crypto fear and greed index is firmly in fear, sitting between 26 and 30. Why is there such a huge gap?
It just highlights the internal fragility of the crypto space. It's structurally different. Crypto volatility is high, and it's heavily influenced by leverage and these really quick liquidation events that are, walled off from the rest of finance.
So a low VIX means systemic calm, but high crypto fear means it's vulnerable to its own internal shockwaves.
Exactly.
And what about those really high-risk, high-beta assets you track in the report?
We're seeing extreme risk profiles there. Tokens like HYPE trading near $28, $29. They're showing massive swings, and more importantly, the pre-stocks market.
These are shares of private companies, right? Anthropic, XAI, OpenAI.
Yeah, traded on specialized secondary platforms. They're extremely high beta, meaning they amplify volatility, and they carry huge liquidity and custody risk because they aren't on public exchanges. The liquidity risk alone is a major, major red flag.
Okay, this brings us to the most crucial part, strategy. Given this dual-axis market RMP setting the floor, NVIDIA setting the event ceiling, what is the concise tactical takeaway for positioning?
The windshield view has to be focused on two things: liquidity reallocation and immediate event triggers. Our recommendation really centers on safety and what we call positional elasticity.
Positional elasticity. That sounds like holding cash so you can react quickly.
That's a big part of it. Maintain healthy cash reserves. Then, for your core holdings in broad indices like VOO and QQQM, we advise using phased buying.
Entry in batches.
Exactly. RMP is a brand new tool, and the market is still digesting its long-term impact. So entering in batches hedges against policy uncertainty and any sudden pullback from the NVIDIA drama.
And how do we hedge against the volatility and policy risk created by RMP itself?
You use small tactical hedges. Short-term government bonds or high-quality money market funds are really useful as a risk-off position here.
Makes sense.
Or alternatively, you could consider a small allocation to a gold ETF. Gold spot is near $4,306 an ounce right now. It's being supported by both safe haven demand from the geopolitical risk and as a hedge against the possibility that RMP actually is a precursor to more liquidity.
So strategic, phased buying for the core, small hedges for the risk. What's the final, most urgent caution for people engaging with those volatile, headline-driven names?
If you're trading those assets names like Circle, Coinbase, Robinhood, CRCL, CoinHood, you have to maintain a strictly short-term focus. These moves are defined entirely by headlines.
This is not long-term investing.
Not at all. And most importantly for crypto, keep your total exposure small, and you must strictly avoid or limit the use of leverage and perpetual futures. That is the primary source of the system's instability. That is where the rapid, devastating liquidations happen.
That's a very clear framework for a very complicated environment. We've seen the Fed implement RMP to supplement short-term reserves. It's a technical move, coming when inflation is falling but still high, and employment is robust.
Right. It's not a panic move. It's a calculated adjustment. And building on that, here's the question for you to really think about as you digest all this.
Okay.
If the Fed's RMP operation becomes a persistent structural tool, something used regularly to manage the short end of the curve, does that fundamentally alter the market's long-term expectation for inflation? Or is it really just a temporary, sophisticated technical fix with no long-term policy implication?
And that strategic question structural change or temporary fix, that's what institutions are debating right now.
It's the single most important variable defining how the market is going to price risk for the next several quarters.